Sure. Thank you. Thank you so much, ma'am, for the kind introduction and good evening, everyone. Thank you, Taxmann team, for inviting me on this webinar on GST implications on e-commerce operators. Before we get into the GST issues in specific, I thought we'll just spend a few minutes to lay out the broad e-commerce world for all of you. So, while the word e-commerce is typically known for trading of goods, services, or information over the internet between two persons, with the E standing for electronic, as you all know. So it's how you're able to shop and purchase anything entirely online, right? So this sector has evolved and attained a foothold in the Indian market and picked up a significant momentum during the past few years, which is further accelerated by the various compulsions on account of COVID-19. And clearly this sector has become a very integral part of everyone's life, right? So it kind of extends huge benefits to all of us, not only to the trade but to we as consumers as well. And we all are now attuned to the fact that goods and services are available online. They are cheaper than the traditional mom and pop shops. They have massive discounts. They have facilities like doorstep delivery, as well as easy return of goods or cancellation of services anytime. Talking about this sector, we are seeing exponential growth. By one report by IBEF, we are seeing the current sector to be at around $50 billion in India, which will exponentially grow to 120 billion in the next 3 years and possibly 200 billion in 5 years. So it clearly shows huge potential of growth. Uh, and before we get into the GST part, it's important to understand the regulatory framework for this sector, because a lot of the business models that we'll be talking about will be driven by how the FDI policy on e-commerce today dictates the manner in which this sector performs. So three key points I like to make on the FDI policy. One, the FDI-backed e-commerce entities can only operate as a marketplace and are expressly prohibited from operating as an inventory-based model. Second, these platforms cannot have equity share or control over the inventory of the sellers on their platform, either directly or through any of the group companies. Also, there is a limit of up to 25% of the seller's inventory that can be sold by the marketplace to the seller. And last, these e-commerce entities cannot influence the sale price directly or indirectly of the goods that are being sold on its platform. While there are few other points, but these are three important points to keep in mind as far as the FDI policy goes. Uh, Now, as you may note that the FDI policy is governing those entities that are FDI backed. But what happens to companies who are locally funded? Now, unfortunately, there are no specific guidelines that are laid out for such companies. While the government, recognizing this disparity, is working on a comprehensive national e-commerce policy that will cover all the aspects for this sector. So, with this as a background, maybe it is the right time for us to get down to the GST landscape, and maybe we'll go to the next slide. In this webinar, what we propose to do is to give you an overview of the various e-commerce business models that are adopted by the industry. As you see, we'll cover the marketplace model, the inventory model, and the aggregator model. We'll cover each of these business models in detail, giving you the way the business model is structured as well as the GST implications. Within the GST implications, we'll also cover the TCS implications, the TCS when it comes to the GST TCS and not really the income tax one. And finally, we'll round it up with some of the issues that are relevant for this sector. So moving now to the various business models that are there under e-commerce. As you see on the slide, the e-commerce sector as such, is actually a bedrock of innovation, because it introduces new business models every other day and also disrupting the existing ones. While there can be various types of business models that are evolving every day, we've kind of bunched them into three major business models which we'll discuss. First is the marketplace model, which is the most prevalent. This, like I mentioned, is predominantly dominated by the FDI backed companies. This particular model provides a platform which acts as a facilitator between the buyer and the seller. In this case, the platform merely helps in bringing the buyer and the seller together on the online platform, while the supply is made directly by the seller to the buyer. Traditional examples that you've known for marketplace models could be, platforms like Flipkart, Amazon, and the like. Second, the inventory-based model where the platform itself owns and supplies the inventory. It could be goods or services, and it directly transact with the end customers through its platform. Some examples could be like, we know Shopper Stop or Tata Click. These are inventory-based models that are there. Third is the aggregator model. Here, services are being provided by various service providers. It could be individuals, but they don't provide services on their own using their own brand, but they use the aggregator's brand name or trade name. So, as an example, we all are familiar with cab aggregators like Uber and Ola, and many other aggregators. It could be Urban Clap, etc., who are primarily aggregators where the service providers are rendering the services under the aggregator's brand. While marketplace and inventory based models can be for goods and services, the aggregator model is typically for services alone. Moving to the next slide on covering the marketplace model, uh, we we know that the marketplace model is like I mentioned is a platform where it acts as a facilitator between the buyer and seller. Here we'll discuss two scenarios, and this slide captures the first scenario where you can see the marketplace as depicted as ECO, e-commerce operator, right in the middle. And the ECO connects the seller. If you see seller on the left and the customer on the right, the sellers are typically listed on the platform and they are identifiable as a seller to the customer. But in some cases, you could also have sellers who are not independently listed on the platform, but they merely list the product catalog without disclosing the details of the sellers, because there could be many sellers providing the same product as well. As the customer places the order on the platform, the ECO shall forward the order to the designated seller, who shall then directly supply the goods or services to the customer, along with raising the tax invoice on the customer as well. For the purpose of the delivery as such, there could be delivery partners that could be contracted through the ECO to ship the goods to the customer, or the seller may have its own delivery partners to supply the goods to the end customer. When it comes to the ECO's business model or revenue source, the ECO may earn from multiple sources. For example, it could charge commission to the seller, it could charge commission from the delivery partner or the customer for delivery charges as well. Separately, as you see on the right, the seller may also earn through listing fees. It may earn through various other ad revenue from advertisements on his website and many other sources. So these are typically the basis in which the ECO operates. Now, we'll now get on to the broad level GST implications in the next slide. What you see here is, three particular transactions that we'll cover. But before I get into that, it is important to note the GST law with respect to the e-commerce model. Specifically with respect to registration, the GST law provides certain exceptions when it comes to registration under GST if supplies are being made through e-commerce. As we all know, by default, the registration threshold for goods is 40 lakhs and for services is 20 lakhs, which means that only if they cross this amount that they need to really register under GST and comply with the law. But Section 24(9) of the CGST Act makes it mandatory for the sellers to register under GST irrespective of the threshold limit if they are transacting online. This clearly means that there is a disparity between the online and offline sellers. In addition, uh, we also have under GST a provision which is called the tax collection at source. This is basically for the e-commerce marketplace entity to actually deduct 1% on the value of the transaction that is being made through the platform. This amount is being deposited on a monthly basis and allowed as a set off to the seller against its GST liability. And we'll talk more about the TCS provisions in detail as we go along. But this is broadly, the background of the GST law. Now, with this background, if you see the GST implications on each transaction in case of supply of goods by sellers listed on the platform, like I mentioned, there is no registration threshold, and therefore sellers cannot transact online till they obtain a GST registration. This clearly means a huge impediment on the sellers to go online. This challenge actually has been highlighted multiple times by the industry before various stakeholders within the government. Most recently, the Parliamentary Standing Committee on Commerce released its recommendations on the e-commerce sector. While it covered various aspects, they also recommended to the GST Council to relook at this provision to bring in parity between the online and offline sellers and mitigate the huge compliance burden on the online sellers. Hopefully, we should see some changes in the upcoming GST Council meeting to provide relief to these online sellers. When it comes to TCS, as we know that every transaction of goods through the e-commerce platform, which is a taxable supply under GST, will be subjected to TCS mandatorily by the e-commerce platform. So there will be a TCS, on this transaction. When it comes to supply of services, the government has relaxed this requirement of mandatory registration for service providers, and therefore the registration, compulsion does not apply to service providers. It is aligned with the offline service providers, while TCS provisions will only apply if the service provider has obtained registration after crossing the threshold. And finally, when we talk about the delivery partners as a business model, it is important to note that the industry is divided in the way the delivery partners work. There are some platforms which provide the delivery services on their own to the sellers or the customers, but there are some platforms where these are being provided independently and directly by the delivery partners to the sellers or the customers. Therefore, the GST threshold and the TCS implications would not be applicable where the delivery services are being rendered by the platform themselves, because the platform will then discharge GST on the delivery services itself. But it will be relevant to examine this in the hands of the actual service provider when the services are being rendered by the delivery agents itself. So the delivery agents will require GST registration only if they cross the threshold of 20 lakhs per annum, and then TCS will become applicable on their income if they become liable to registration as well. Now, one of the issues that arise on TCS is whether when the seller is not listed on the platform, directly provides the services to the end customer. In this case, the question is whether the supply of goods or services is made by the seller through the marketplace or not. So in the context of TCS, as I mentioned, TCS will apply only when the supply is being made through the marketplace. And therefore, it is important to see whether seller is not listed, whether the supply is still being made through the marketplace. And for this, we'll like to take guidance from an advanced ruling order that is passed, which we'll just discuss in the next slide. So in this case, this is the case of Opta Cabs Private Limited, wherein the appellate authority for advanced ruling in the state of Karnataka, while looking at the provisions of Section 9(5), it has laid out some broad principles to determine when the supply is being made through an e-commerce operator. To lay a background to this, in this case, the company was a cab aggregator. It sought clarification whether the services of the individual cab drivers to the end customers can be said to be a supply through its platform. The company argued that it was merely allowing the taxi operators to obtain membership for usage of its mobile application without collecting any commission for each of the transaction and without collecting the taxi fare from the customer as well, because the customer paid to the driver directly. In this case, the Appellate Authority for Advanced Ruling held that the taxi services were still provided by the e-commerce operator as they existed an offer that was being made by the supplier of service, in this case, the taxi operator, and an acceptance of that offer by the customer. And both the offer and acceptance was made through the platform itself, thereby leading to a contract for supply of goods or services between the supplier and the customer. Therefore, this becomes an important criteria for us to determine, when a transaction has been executed, whether it is through the platform or not, for the purpose of determining its GST implications. In the case of unlisted supplier, like we were talking in the previous slide, if the unlisted suppliers are not necessarily making an offer for sale to the end customer on the platform, but are merely obtaining orders from the platform, there whereby the platform obtains the order and then passes it on to the supplier. One can hold a view that there is no supply being made through the platform, and therefore GST provisions like TCS may not be applicable. But clearly, some of these are fact dependent, and we will have to be very sure of these facts before a conclusion is taken. Another question that arises is whether the supplier of goods, in this case, where the supplier is unlisted, is not registered for GST purposes, whether mandatory GST registration is required under Section 24(9). Again, the position can be taken in this case that the seller may not have been transacting through the platform, but has merely obtained an order from the e-commerce operator to supply the goods, and therefore the transaction cannot be made through the platform. Therefore, the seller may not really require mandatory registration when he's below the threshold. While this position is untested in the courts, for the e-commerce platform, it is important to examine its model very closely, given that there are specific provisions in law to determine this position, and penalties can be levied on the platform if it kind of facilitates sales by sellers who are unregistered but require registration. So it's important for the platform also to be clear on this position before it onboards any of these sellers. Is moving to the next scenario where as you may see on this chart, there is actually an additional ECO in the structure where actually the customer lands on the platform or the application belonging to ECO 1, and through that platform the customer is able to view the sellers who are actually listed on ECO 2. There actually is going to be an agreement between ECO 1 and 2, whereby the sellers and the customers are able to transact through this mechanism. Another change that you see on this slide is the payment collection, right? So there is an independent company who has an arrangement with ECO 1 to collect the payment from the customer on behalf of ECO 1. So the issue here that arises are two. One is how does TCS apply where there are two e-commerce operators in the model? For this, thankfully, the CBIC has issued a clarification. Rather, they have issued an FAQ for TCS provisions in October 2018, where they've clarified that the TCS provisions will be applicable in the hands of ECO 2, who shall deduct the TCS, because the ECO 2 shall be the person who is responsible for making payment to the seller, and in a way, it will become more conducive for ECO 2 to be able to deduct and pay the TCS, and therefore, ECO 2 will have the TCS obligation. This will therefore then relieve ECO 1 from any of the TCS obligations, even though it has collected the amount from the customer. It will then remit that amount to ECO 2, who will deduct that TCS and comply with the GST law. Another issue that arises is, when there is this independent payment management company, as you see in the slide, to whom the customer makes the payment for this transaction. The issue arises is whether there is going to be a TCS applicable at all in this transaction, because there's an independent payment company to whom the customer makes a payment. Here, again, the CBIC has clarified in its FAQ that because the payment management company is actually collecting the amount as an agent on behalf of the ECO, and collecting the amount from the customer, they have clarified that the ECO is the one who's liable to do TCS, even though there's a payment company in between, and the payment company is acting on behalf of the ECO. If the payment company did not act on behalf of the ECO but acted on behalf of the seller directly, then there can be a position that TCS may not apply, and because the payment is collected by the seller directly from the customer through the payment company, and hence TCS may go away. But in this case, because it is on behalf of ECO, the TCS provisions will apply, and therefore in scenario 2, as we see in this entire diagram, because there are two e-commerce operators applicable, the responsibility of TCS will shift to ECO2, who's making the payment to the seller, as explained earlier. So this is broadly, the TCS implications in scenario 2. We move to the next slide, where we'll cover some of the other issues on this model. So as you see, one of them is with respect to export and import transactions. In a situation where the supplier is exporting goods outside India, whether TCS will be applicable as a responsibility. As we know, exports are actually zero rated, and therefore, if there is no tax on it, will TCS still be applicable? Now, under the TCS provisions, TCS is mandatorily applicable to all transactions which are taxable. Exports are also taxable, and hence TCS may unfortunately be required to be deducted, even if there is zero tax on the output. Being taxable supplies, TCS will continue to be applicable. In this case, the supplier may either adjust that TCS amount against any other supplies, or claim a refund of this TCS amount as it is being deposited in the cash ledger of the supplier. The other issue is whether TCS applies on exempt supply. The FAQs have clarified that TCS is not applicable on exempt supplies, and hence we don't need to undertake that. The last is on whether TCS applies on import of goods. TCS doesn't apply on import of goods because these are transactions kept outside the net of the GST law, and hence TCS may not apply on the import side. The second is with respect to C2C sales. Now, these are sales that you see typically on websites where people may want to dispose out their used furniture or cars, etc. And in this case, a platform connects one consumer to another consumer. In this case, whether TCS applies in the hands of the commerce operator. As we know, the definition of supply only covers supplies made by the person in the course of his business, and therefore this is not a taxable supply, and hence TCS does not apply on this transaction. The other issue is with respect to sharing of discounts. Now, in this case, the discounts can be shared between the ECO and the supplier. The issue is if the customer is getting a discount of say 100, but the seller bears only 70 as the discount, whether GST needs to be paid by deducting the amount of 70 or 100. Here, because the seller bears only 70, the taxable supply value in the hands of the seller has a reduction of only 70, and hence GST needs to be charged on the balance and not reducing the entire 100. So these are broadly the issues under the marketplace model. We now move to the other models with respect to inventory based. As you see, the inventory based model primarily covers where the ECO owns the inventory and supplies that to the customer, and in the back end it may procure the goods or services from another supplier which may not be visible to the end customer. And therefore, for the customer, the ECO is the supplier of goods. In this case, the goods may be directly shipped by the supplier to the end customer, whereas the invoice will be issued by the ECO to the end customer. The GST implications here are pretty much similar to any other retail sale that a retailer may undertake. The GST credit is entitled in the hands of the e-commerce operator on its purchase, and there are no TCS provisions that are applicable because the supply is being made directly by the e-commerce operator itself. The issue happens with respect to reseller of services. In this case, as you all know, that when it comes to services, we need to identify the place of supply because there are two legs of the transaction when it comes to services. The place of supply becomes very important to determine, especially where the place of supply is determined basis the performance, the location of performance of the services, because the e-commerce operator will have to obtain registration even though the services are actually being rendered not by the e-commerce operator but by another supplier. So the e-commerce operator may require registration in the location where the actual services are being rendered. Here, what is important to ensure that this particular model is an inventory-based model, we need to undertake a close review between the agreements between the e-commerce operator and supplier and the agreement between the e-commerce operator and the customer for us to determine that there is actually a buy-sell transaction that is actually happening between the supplier and the e-commerce operator and the e-commerce operator and the end customer, and therefore conclude that this being an inventory-based model, there are no TCS implications, and the supplier may not require mandatory registrations as well. Moving to the next on the aggregator model and spend a few minutes on that. The GST law really covers a particular provision, which is section 9(5), which in a way deems the services to be provided by the individual service providers as a deeming fiction that these services are deemed to have been provided by the e-commerce operator. Uh, and Section 9(5) requires a specific notification under which these services are deemed to be taxable in the hands of the e-commerce operator. Till date, we've seen that the government has notified four broad categories of service providers that are getting covered under Section 9(5). One is the transportation of passengers by radio taxi, motor cab, maxi cab, and motorcycle. As we all are familiar with various cab aggregators and bike aggregators. The second is accommodation of by hotels, where the service provider is not liable to register under GST. Typically, hotels who are below the 20 lakh threshold will get covered under this category. The next is various other small services that are being rendered by small service providers like housekeeping, plumbing, carpentering, etc., where they are below the threshold of 20 lakhs. Again, here under Section 9(5), the e-commerce operator is deemed to be the service provider. And the last and the most recent has been restaurant services, whereby the e-commerce operator is liable to pay GST on restaurant services, other than those restaurants that are being located at a specified premise, which is five-star hotels. So we'll get on to understanding each and every scenario that are covered under Section 9(5). To begin with, the taxi or bike aggregators. In this, again, as you all may visualize, either examples of Uber or Ola or any other such aggregator, where the platform actually provides an IT application through which the customers access that and book a particular service by a taxi service provider. The customer typically pays through the e-commerce operator, or at some point in time may also pay directly to the taxi service provider. Now, the GST law has deemed that these services that are being provided through an e-commerce operator under Section 9(5), the e-commerce operator will be deemed to be the service provider and liable to pay GST on all such services that are being provided through its platform. Now, independent of this liability under Section 9(5), the e-commerce operator is also liable to pay GST on its platform fees as well, which is independent of the amount it collects from the customer In a way, if the customer pays 100 for the taxi ride services and the e-commerce operator collects 30 as its commission, in a way, the e-commerce operator will be liable to pay GST under section 9(5) on 100 and under its normal provisions on the 30 rupees at the GST rate of 18%. The question arises whether e-commerce operator will be required to do TCS as well. Now, the TCS provisions have made a specific exclusion for services that are being subjected to GST under section 9(5), and therefore there is no TCS that applies in case these services are covered under 9(5). Moving to the next scenario of hotel aggregator, very similar business model where the e-commerce operator runs a platform through which the customer makes bookings of hotels. As I mentioned, this is applicable only where the hotel is unregistered under GST. Will the e-commerce operator be liable to pay GST on behalf of such unregistered hotels? In a scenario, we could have a scenario where the e-commerce operator is either located outside India or within India as well. Now, the GST implications here could be twofold. One, like I mentioned, for unregistered hotels, because they are unregistered under section 9(5), the ECO will become liable to pay GST. But if the hotel is registered, then the hotel continues to pay GST on its services, but the e-commerce operator will have to deduct TCS. So it's important for the aggregator to ascertain whether the hotel is registered under GST or not, and accordingly pay GST or deduct TCS accordingly. Another scenario is where if the e-commerce operator is outside India, what happens in that case when it comes to section 9(5). The GST law is clear that if the e-commerce operator is outside India, then it will have to appoint a representative for the purpose of discharging GST under section 9(5) and continue to pay GST on the unregistered hotels. For the commission, the e-commerce operator will raise GST invoices, and where the e-commerce operator is located outside India, then the commission may not be subject, or sorry, may be subject to GST or may not be subject, depending on the position on intermediary for the e-commerce operator that the hotel may take. A few quick questions that arises on this scenario. The GST on minimum guarantee payments that are being received by hotels is being a subject matter of disputes that we are seeing by the authorities. Minimum guarantee payment is an amount that is paid by the e-commerce operator to the hotel in case it's not being able to reach a particular targeted revenue. In this case, because the hotel earns a minimum guarantee amount, the hotel will be subject to GST on such minimum guarantee payments that it receives from the e-commerce operator. Another issue that arises is whether the e-commerce operator is required to obtain GST registration in each state under section 9(5), because it'll have to pay GST to that respective state, or can it take a single registration and pay GST? The law has clarified that unfortunately the e-commerce operator will have to obtain state-wise GST registration and discharge CGST and SGST for the hotel services that it pays GST on behalf of these unregistered hotels. And finally, in the case of registered hotels, but if the ECO is outside India, will it be liable to deduct TCS? Again, the FAQs have clarified that the ECO who is located outside India will be required, to obtain registration and deduct TCS, in this case where the hotels are registered as well. So these are the broad issues that arise for hotel aggregators. Moving to the last scenario on restaurant aggregators. Here again, not very different, but if you can imagine a platform like Zomato or Swiggy, which actually connects a restaurant to the end customer, whereby the customer pays the ECO for such restaurant services. And from Jan 2022, the ECO is being made liable to pay GST on behalf of the restaurant services that are being rendered through its platform. And the ECO continues to pay GST on the platform fees. The issue arises is with respect to what is a restaurant service, what will qualify as a restaurant service. Because if the supply is by a non-restaurant, then the liability does not shift to the ECO but continues to be in the hands of the supplier. Therefore, the question is, what is a restaurant service? Now, restaurant service is defined under the GST law as supply of food by way of a service by a restaurant, and therefore each e-commerce operator will have to see whether the services that are being rendered by that establishment, is it qualifying as a restaurant service or not. We have seen a lot of disputes that have recently emerged when it comes to various supply of services by a restaurant. So for example, if a restaurant is supplying packaged food along with cooked food, whether it's qualifying as a restaurant service for both these supplies, and therefore if it does, then whether GST will have to be shifted in the hands of the e-commerce operator. The issue therefore arises is, what is the responsibility of the e-commerce operator in terms of determining the correct classification of such services? Because any incorrect classification may lead to an error in tax compliance in the hands of the e-commerce operator. As I mentioned, only restaurant services are liable in the hands of the e-commerce operator under Section 9(5), whereas non-restaurant services, like for example, packaged food, could be a non-restaurant service, continues to be taxable in the hands of the restaurant itself. The TCS implications will therefore then fall in the hands of the e-commerce operator only for non-restaurant services, whereas there is no TCS when it comes to restaurant services, because the e-commerce operator pays tax under Section 9(5). The last issue is other examples like bakeries or sweet shops, standalone ice cream parlors or chocolate shops, whether these are supplying food and beverages that are restaurant services. If yes, then they are covered under Section 9(5) in the hands of the e-commerce operator. If no, then they continue to be liable to GST in their own hands. In the case of ice cream parlors, the government has clarified that they are not qualifying as restaurant services. They are liable at 18% GST, and therefore the e-commerce operator will not discharge GST under Section 9(5) for ice cream parlors. Likewise, a similar analogy may be extended to bakeries and sweet shops as well, though they are not specifically clarified. Again, this becomes a gray area for the e-commerce operator to take a position, whether they need to pay GST under Section 9(5) or whether that is liable in the hands of the restaurants themselves. Moving to the next slide on the TCS implications. Now, I have talked about Section 52, in the previous slides, but just getting down to the specific of these sections when TCS applies. Now, TCS is applicable on in the hands of every e-commerce operator who collects an amount of TCS on the net value of taxable supplies that are being made through it by other suppliers, where, and this, the last condition is very important, because the consideration with respect to such supplies is to be collected by the e-commerce operator. If all the conditions are not satisfied, then TCS may not be applicable, and therefore it is therefore important for e-commerce operators to examine when TCS will become applicable or not. As I mentioned, the TCS rate today is 1%, and the type of TCS, whether it is CGST or SGST or IGST, will depend on the nature of the tax that is charged on the underlying supply. With respect to registration, as I mentioned earlier, the TCS the e-commerce operator will be required to obtain TCS registration in every state where the supply is being made. With respect to the 1% applicability on what value, the computation of the value, here the law provides that the TCS needs to be computed at a supplier level on a month-by-month basis, which means that I need to aggregate the value of supplies made by each supplier. And here the net value of taxable supplies excludes the value of returns that are being made to the supplier in that month. And therefore, I compute the net value on the basis of each supplier for each month, and then apply the 1% on that value. And at the end of the month, I file a GSTR 8, whereby I disclose the supplier-wise net value on which the 1% is computed. This form GSTR 8 is required to be filed by 10th of every month. And upon filing of this GSTR 8, the value that I disclose as an e-commerce operator will reflect in the hands of the supplier, whereby there is a concept of matching. In case the supplier does not disclose the same value as shown by the e-commerce operator, then the unreconciled revenue will be subject to additional GST liability in the hands of the supplier. So this matching concept is also extended to GSTR 8, whereby the sellers need to ensure that the revenue they report is also matched with what is being shown by the e-commerce operator. So getting down to the specific issues that are there in this, this illustration of the TCS here shows that there are two scenarios. One is an intrastate supply and the other is the interstate supply. In the case of a particular supplier, where in the month of June, if he's got 1,200 as intrastate supply and 2,500 as an interstate supply, and in the same month, there are returns that are being made both for intrastate and interstate supply, being 200 and 500 respectively, where credit notes are issued by the same vendor. After deducting that, I arrive at the net value of 1,000 for intrastate and 2,000 for interstate, on which TCS becomes applicable on the 1,000 for 0.5% and 0.5% for CGST and SGST, and 1% when it comes to the IGST amount. Basis that the tax amounts are being computed. So this is how an e-commerce operator needs to arrive at the exact TCS amount for every supplier on a monthly basis. So it's important to note that the e-commerce operator will have to deduct this amount and pay the TCS amount in cash. The vendor will actually see this amount sitting in their cash ledger. The vendor can either utilize the TCS amount for making payment for his tax liability in his outward supplies, in his 3B, or if there is excess amount of TCS that is sitting in his cash ledger, then the vendor can actually claim a refund of the cash ledger pertaining to the TCS amount that is credited. One of the issues that arises is whether the TCS is applicable on cash on delivery orders. Now, as we know, in a cash on delivery, what happens is that the cash amount is not collected directly by the e-commerce operator from the customer, whereas it is collected by the delivery agent and paid to the seller directly. In this case, the issue arises whether one of the conditions of Section 52, which is that the amount that is being paid is being collected by the e-commerce operator, whether that is getting satisfied here or not. The answer to this depends on whether the delivery executive who's collecting the amount is collecting on behalf of the e-commerce operator, or is it being collected on behalf of the seller. Typically, the amount is being collected on behalf of the e-commerce operator, and hence TCS will be applicable even on cash on delivery orders as well. But it depends on every fact, and therefore conclusions on that will depend on the exact facts. So we've covered the broad issues, under various models. We'll now get down to specific issues. Now, talking about cloud kitchens. Now, we all are familiar with the fact that we order food online through an e-commerce operator, but in the back end, it could possibly be not a restaurant, but a cloud kitchen who's actually, cooking the food and supplying that food to the end customer. In this case, the issue arises with respect to whether this is a restaurant service taxable at 5% GST, and hence the liability shifts on the e-commerce operator, or whether the services is not a restaurant service but taxable at 18% in the hands of the restaurant itself. And therefore, the answer lies in the fact whether the cloud kitchen actually qualifies as restaurant services or not. As I spoke earlier, restaurants services is supply of goods being food through through a particular service by a restaurant. The issue arises whether cloud kitchen is a restaurant or not, because as we all know, a cloud kitchen is not like a typical restaurant because it does not have any seating area and there is no service that is being provided in their premises. But the issue is whether the cloud kitchen still qualifies as a restaurant, and GST is applicable at 5%. The CBIC actually were appraised of this issue and thankfully clarified, and this issue is now reached certainty, whereby the CBIC has clarified that the cloud kitchen does qualify as a restaurant because of the fact that it does prepare cooked food and supplies that to an end customer, irrespective of the fact that that is not being supplied at its premises without having any seating area. And hence, the cloud kitchen continues to enjoy the GST rate of 5%, having qualified as restaurant, and therefore it supplies restaurant services to the end customer. It also means that because it is satisfying the restaurant services definition, the liability to pay GST has now shifted to the e-commerce operator, as I mentioned while talking about the aggregator model, whereby the platform is now liable to pay GST under Section 9(5) on behalf of the cloud kitchen. Moving to some of the other issues that we've seen. Now, this may not be something that is visible directly as a transaction between the customer and the supplier, but these are certain arrangements that are applicable behind the scene. These are, for example, the co-branding or marketing arrangements, whereby there are various arrangements between the platform and the supplier, whereby there is cross marketing services that are being rendered between the platform and the supplier. In a situation where the supplier uses the brand of the platform, or the platform uses the brand of the actual supplier while carrying out its own marketing activities, the issue arises whether some of these co-branding arrangements where there is no actual exchange of money for such co-branding arrangements, whether these are still subjected to GST under whether these transactions could be regarded as barter and therefore liable to GST. Now, in a situation where there are specific roles and responsibilities that are identifiable for carrying out these marketing services by one for the other, this may be regarded as barter, and a value may be required to be ascribed to such barter transactions for each of these limbs of the transaction to be subjected to GST, and credit is being therefore allowed in the hands of the recipient. Now, therefore, one will have to really deep dive into examining the marketing the agreement to see whether there is actually a barter arrangement that is actually arising by looking at the roles and responsibilities of both the players. One also will have to look at whether one of the parties is outside India, and hence whether the marketing services which are being rendered in India would be regarded as intermediary. Thereby, the GST credit to that party outside India may not be allowed as well. So some of these co-branding arrangements will require a deeper analysis to determine whether there is a barter. If yes, what is the value on which you pay GST? And third is whether input tax credit will be required, will be available to the recipient as well. Talking about barter, we've actually seen various arrangements where services are being provided by both the parties in a contract without consideration. And similar to co-branding arrangements, even normal transactions will have to be examined in detail to see whether there is a scenario of barter that arises, and therefore what happens to the value on which GST is applicable, and whether input tax credit is allowed in the case of barter as well. So with this, we come to a close on the slides, and possibly we can take some of the questions that have come from you. The first question is, what will be the implications if the e-commerce seller raises invoice on the commerce operator, and the operator in turn raises invoice on the buyer. The what the question is, the invoice amount may or may not be the same, and therefore the question is, what will be the GST implication in this case? Now, as I mentioned earlier, in a typical inventory-based model, where the seller actually raises the invoice on the commerce operator, and the commerce operator loads its margin on top of that, and then raises the invoice on the buyer. In this case, there is GST that is applicable on both the legs of the transaction, having fallen under that inventory model which I explained earlier. And GST credit should be allowed in the hands of the commerce operator for the amount that it pays to the commerce seller. In this case, just a word of caution is with respect to the fact whether the commerce operator is entitled to carry out retail sale to the end customer under the FTI guidelines. So one will have to be very careful to see whether the e-commerce operator is allowed to actually carry out this transaction under the FTI rules. If it is, then the GST implications become in a way very simple for them to pay GST on that. The other question is with respect to if the items purchased through the e-commerce operator are delivered to the e-commerce operator, who then delivers it to the end customer, whose address should be mentioned on the invoice issued by the seller, whether it should be the customer's address or the e-commerce operator's address. Now, in this case, because the seller is actually raising the invoice to the end customer, the seller, is required to mention the address of the e-commerce operator only from a shipment standpoint, while the e-commerce operator will then deliver the goods to the end customer. Ideally, the address of the end customer is the one that needs to be reflected, because the sale happens directly from the seller to the end customer, and hence it is better suited that the seller reflects the address of the end customer. Uh, the other question is, can you give one example where two e-commerce operators is engaged in a transaction? So for example, we have scenarios where travel, where if you go onto a portal like Make My Trip or Clear Trip or Yatra, now this is one e-commerce operator, whereby then you will see various hotels that are being listed on Make My Trip. Now, hotels could be, for example, hotels that are run by various other aggregators like Marriott or many other such hotel aggregators who list their properties on a platform like Make My Trip, and whereby a customer like you and me may visit a platform like Make My Trip and place an order or book a hotel room, but actually the hotel that we are booking may actually be run by an independent service provider, whereas there is another marketplace that is actually listed on Make My Trip, and therefore you see that as an example of two e-commerce operators on the same transaction. The other question is, if the seller has not registered and sells goods under the e-commerce platform, who will collect the GST and pay to the government? Because the example that is being spoken about nowadays is a lot of homemakers who are selling their products on the platform. Now here, I just want to recap the fact that if there are goods that are being supplied on the e-commerce platform, then the seller is mandatory required to obtain registration for supply of goods under an e-commerce platform, even if it's by homemakers who are selling products on the platform. Unfortunately, the homemaker will be required to obtain registration and pay GST to the government. This is where I had mentioned the fact that it adds unnecessarily compliance burden, and in a way discourages homemakers to register and sell online, because it mandatorily requires them to register under GST. Hopefully, we'll see some relaxation in days to come on this front, because the government recognizes the fact that they should do away with the mandatory registration for goods, because for services there is no mandatory registration, like I mentioned earlier. Uh, Another question that is there is, which is more beneficial, inventory based or marketplace? Now, honestly, for both the models are implementable, but it all depends on the FDI guidelines. Like I mentioned, if it is FDI backed entity, then the marketplace model is the only model that is allowed to carry out. Whereas for a locally funded e-commerce operator, it could choose between either an inventory based or a marketplace model. Clearly, inventory-based models have lesser compliance, and therefore, purely from a GST standpoint, an inventory-based model will be something that is more advisable. I think we'll take one last question, which is if an entity provides online professional services pan India and provides few services offline additionally to their local clients, then whether such entity has to register themselves as an e-commerce operator, also whether such entity needs to register for GST state-wise. Now, because these services that are being provided is an online professional services, uh, this is being rendered all India. One is to note that the GST registration threshold of 20 lakhs for services will be applicable even for such entity who's providing online professional services, because the threshold applies to services but does not extend to goods. So they will have to register themselves under GST. The issue is whether such entity has to register themselves as an ECO. If it is providing services directly online, they don't need to register as an ECO, because they are not supplying services through another platform, but providing the same services online directly to end customers. Therefore, they may not require registration as an ECO. But if they do choose to go through a platform, any other marketplace like Amazon or any other, or Flipkart or any other platform, then such online professional services rendered through the platform, will make them require registration, though not as an ECO, but directly as a service provider. So the other question is whether such entity needs to take registration state-wise. This again, if it is providing services through an ECO, then they may require state-wise registration if they are crossing the threshold of 20 lakhs, and if they are rendering the services through any other branch in that state. If there is a single place of business from where they render services, then they may not require state-wise registration. So I think with that, we've kind of answered most of the questions that have been asked. Of course, if there are a few other questions that are there, which for want of paucity of time, we've not been able to address, but we've covered most of the questions. In case there are any questions additionally that may come, please do feel free to reach out to us directly as well. With that, I'd like to come to a close on this webinar, and hand it over back to the Taxman team for closure.